this computer. Okay, guys, I'm super excited today to bring Wes Matejka from Tax Vantage. Wes is somebody I've known for years, and him and his team are some of the best I've ever seen in the area of high-level tax savings. So Wes lives in Florida, but he works with people all over the country, and I'm super excited to have him explain one of their strategies that is for people that have highly appreciated assets, such as their business. It could be real estate, whatever, but they're trying to find a way to not own that property so that they can reinvest somewhere else. And he's got an incredible strategy that works like nothing I've seen. So with that, Wes, take it away.
Thanks, John. And for everyone on this call, I just want to make sure we're really clear. If you own a business, you own real estate, you're planning to own a business or real estate, and you think at some point in the future you're going to be selling that for a big gain, you are in the right place right now, because we're going to show you how to sell a business, sell real estate, experience a large long-term capital gain, and yet keep the money from the sale rather than have the government take 30% or more of what you earned by building that business or sitting through the appreciation of the real estate. So long-term capital gain, RLTCG 30 or long-term capital gain 30-year deferral program actually allows you to do that. You can defer the long-term capital gains for 30 years. Now, most savvy business investors or real estate investors, people who buy and sell things, are familiar with these following programs. These are common everyday things that people have heard of: a deferred sales trust or charitable trusts or seller financing or the dreaded 1031 exchange. Now, these are things that anyone goes to your CPA, they're going to be able to tell you about these. They're going to be able to talk you through them. And I'm going to tell you, all of them have, in my humble opinion, drawbacks greater than their benefit. And there's a way to get a better benefit than any of these will give you without the drawback that these have. And that better alternative is our program, which is basically an installment sale coupled with a monetized loan using IRS code 453. Yes, this is in the tax code. Now, our LTCG 30 is a strategy used to defer paying the taxes on the sale of a capital asset for 30 years while you receive a monetized loan equivalent to 95% of the sale proceeds in a lump sum at the close of escrow. What does all of that mean? Let me break that down into the simplest of terms for you. You can sell your business or your real estate without having to reinvest it into something just like it, or without having to wait to see the proceeds. You can sell it today, walk away from the closing table with 95% of the sale amount with no restriction on what you do with the money, and not pay any taxes on that sale till 30 years in the future. That is the simplest way to explain this very complex strategy. Now, we're going to get a little further into it here. This sale is based on IRS tax code rules that go all the way back to 1913, not something newfangled. This has been around a long, long time. And this is super important. It's supported by an August 2012 Office of the Chief Counsel of the Internal Revenue Service Memorandum. What is that? The top attorney for the IRS wrote a memo supporting this. Now, a lot of times with certain types of legal transactions or tax transactions, people want to see a letter, an opinion letter from a law firm supporting it. It gives them some sort of sense of comfort and a little bit of a protection if it goes awry. Well, this is actually better than that. This isn't some outside law firm writing you a opinion letter on it, supporting it. No, this is the IRS's own attorney writing a memo supporting this transaction. So how does it work? Well, we are what the IRS defines as a third-party dealer, and we're introduced to the transaction before closing. So let's go with I'll stick with business owner example, I think, throughout this, rather than jumping back between business owner and somebody selling real estate, commercial real estate, homes, anything like that will apply. This actually applies to any asset other than a securitized one. In other words, not stocks, but any type of asset that isn't securitized, this transaction can be used for. So let's say you've decided it's time to exit your business, you want to retire, you want to get out, you've got a buyer, and you've got a price and offer that is acceptable to you for what you want to sell the business. Now, at least 4 to 6 weeks ahead of time before the closing, you want to contact John and work with us to get us involved as that third-party dealer in the transaction. We then, per IRS Code 453, at closing, purchase the property from you rather than the buyer purchasing it from you. And concurrently, or at the same exact time as we buy the property from you, the seller buys the property under the original terms between you, the seller, and then the buyer from us. We collect the sale proceeds from the buyer, and then instead of you getting the sale proceeds from the buyer, we work with a third-party lender, a private equity group, to extend a monetized loan to you, the seller. Now, what you're receiving is not the proceeds of a sale, but rather the proceeds of a loan. It's an interest-only 30-year loan. So because of that, the tax obligation is deferred for 30 years or longer, but typically 30 years in this case. And because if you receive the proceeds of the loan, that is not a taxable event. If you were selling a business for $5 million, the buyer gives you, the seller, $5 million, boom, that's a taxable event. You need to pay long-term capital gains on that $5 million minus whatever bases you have left in the business, if any. However, you go down to Bank of America or Wells Fargo or any other financial institution and take out a 30-year loan for $5 million, you do not get taxed on that $5 million. That is not reported as income in any way, shape, or form because it's not income. You have to pay it back. Now, all of those first three things are going to happen seamlessly from the buyer's perspective at one closing. The loan you receive is a non-recourse loan equal to 95% of the proceeds of the close of escrow. What does that mean? Well, first of all, it's a 30-year non-amortized loan. The loan is interest only. It's unsecured, non-recourse. It never shows on your credit report. The loan is paid for the next 30 years every month by an automatic debiting and crediting system where the proceeds of the loan that we got from the buyer are held with an escrow agent earning interest, and that escrow agent takes the interest earned every month and pays the interest due on the loan that we arranged for you from that third-party private equity group. You never make any payments over the next 30 years. That's done automatically for you behind the scenes using the money we received from the buyer, paying the interest on that, paying the loan that we arranged to be extended to you, the seller. You are free to do what you please with the funds from the sale, eliminating the limitation of a 1031, and you get the money all at once in a lump sum versus in monthly payments as you would in a deferred sale trust or seller financing. So always better to get the money now than get it over time, especially over the next 30 years. You don't want to wait that long to get your money. So what happens in 30 years? For the next 30 years, escrow agent A, who has the money that we received from the buyer, is using the interest to pay the interest due on the loan that escrow agent B extended to you. But in 30 years, the loan becomes payable in full, that big balloon payment. And also, when that payment is made, the loan is completed. Now the transaction is a taxable event for you, and taxes are going to be due. So how are both of those satisfied? Well, as for the loan, we, the dealer, satisfy the balance due by paying off the loan on your behalf with those original proceeds received by the dealer at the close of the sale between us and the original buyer. You do not make any payments. I will say you do make some payments over the 30 years. You will make a payment of probably in the neighborhood of about $500 every year. You do have to pay the escrow agent for the work they're doing over the next 30 years. But that $500 a year payment is nothing in comparison to what you're going to see as far as the results. But as far as the loan goes, you never make any loan payments, either on the monthly payments over the 30 years or the balloon payment at the end. Now, the taxes have come due. To satisfy the tax obligation, you, the seller, or your estate in the event of you passing before the 30 years is up, will be responsible for the taxes. The bill does come due eventually. However, thanks to the time value of money and careful upfront financial planning by John Duncan and his team, you're going to be able to eliminate the burden of having to come out of pocket with the necessary funds to pay the taxes in 30 years. Well, how do you eliminate that? Well, thanks to the time value of money. I'm going to show you a few examples here and how you can take a portion of that and pay the tax bill down the road for pennies on the dollar today. What does the transaction look like? Before we get into the examples, what does the transaction look like? Well, this over here, this is you. You're the seller. And this over here is the buyer. Normally, the asset goes straight from you to the buyer, and the money goes straight from the buyer to you, the seller. However, in this case, we buy the asset from you and then immediately sell the asset to the owner, the buyer, concurrently. It's one smooth transaction. The asset actually never lands on us. We never actually appear on the deed. So in the case of things like medical practices that can't be owned by anyone who's not a licensed medical professional, perhaps in some states those rules apply. We never take ownership of it, technically speaking, so it doesn't impact the ability to do this. As we do this, we also have that third party, that private equity group that I mentioned, that we arrange for them to send you the proceeds of a loan equal to 95% of the sale price. And then that is going to be paid. So that's kind of a quick look for those of you who need a visual look as to how the transaction transpires, as to how this is put together. Is it safe? Yes, I'm going to go back and talk about that memorandum from the Chief Counsel of the Internal Revenue Service. We provide this to you when you sign up to have us work on this transaction for you. We provide that memorandum along with other supporting documentation, a list of major corporations, billion-dollar corporations that have been doing this for a long time. This is something they've been doing for years that now we're making available to you, the Main Street millionaire, the person who has started a business, ran that business for years. That business paid you enough money to support your family, but you weren't exactly super wealthy through the years because of this business. You just did well. You supported your family. Now your big payoff is selling the business. This is what's going to support your retirement, or the next big thing in your life is selling the business, not the money you made from the business through the years. Well, because you're in that position, not the position of a billion-dollar corporation, you don't have the resources. Most people don't have the resources to these types of transactions. That's what we do, is we make these billion-dollar company transactions available to Main Street millionaires just like yourself. So let's look at some financial implications of doing this transaction, some side-by-side comparisons. Here's some people who sold their business in Michigan through our transaction last year. They sold the business for $7,450,000. They were going to pay $149,000 in commissions. They did it either way, which would have left them with $7,301,000 in proceeds from the sale before taxes. They had $1.5 million worth of bases still in this business. They had to pay the 20% federal tax and the 5% Michigan tax. They had to pay the 3.8% Obamacare tax. And after everything was said and done, they thought they were going to walk away with $7.3 million from the sale of their business. Imagine their great disappointment when their CPA ran the numbers for them and they found out that what they really were getting at closing was $5,630,000. How disappointing is that? I've oftentimes have said the most disappointing day in an entrepreneur's life is when they go to sell their beloved business that they've worked hard and built, and they think they're making their big payday, only to find out that they're losing 30%, sometimes more, depending on what state they live in, to the government. They thought they were getting $7.3 million after everything was said and done. They were told they were only going to get 5.6. We got brought in on the case. They still have to pay the commissions to the broker who put the deal together for them on the sale of their asset. They pay the 5% difference between what they get in the sale price and the loan. And instead, they walked away at closing with $6.9 million, a nearly $1.3 million difference for them. Now, in their case, they had to take about $390,000 of that $1.3 million difference. And working with their financial advisor, their John Duncan, they were able to take that $390,000 and invest that into, in their case, the best vehicle turned out to be a single premium life insurance policy that gave them a guaranteed cash value of more than enough to pay this $1,670,000 tax bill 30 years down the road. Thanks to the time value of money, $390,000 today will turn into the $1.67 million that they're going to need in 30 years. Based upon, of course, that number is going to be dependent on your age and what, where you're at in life now versus 30 years from now. But in their case, that was an adequate number, which gave them an extra $900,000 to work with as they moved into their retirement years. It's a big difference. And who doesn't want, anyone that doesn't want an extra $900,000 in their pocket going into retirement, you're on the wrong call. So that $900,000, I want to point out one more thing here. Had they taken, instead of just the $390,000 that they needed to cover the taxes, and put the whole $1.3 million into the same vehicle, in 30 years, that $1.3 million would be worth more than the $7.4 million they sold the business for today. They'd make more money off of the gain from this transaction over the next 30 years than they made over the lifetime of their business. That's powerful. Here's another one. Big transaction in California last year, $15 million sale, $900,000 in commissions. They had $1 million in bases. They're going to have to pay the 20% federal tax, the 3.8% Obamacare tax, and the California tax, leaving them with $8.5 million. Ugh. Stop and think about that. They sold a business. They were going to sell the business for $15 million, and all they were going to have to show for it after the government took their cut was $8.5 million out of $15 million. That hurts my head and my heart and definitely my pocketbook. Fortunately, their CPA called us in on the case. We got involved. Instead, they walked away with $13,350,000 at closing, a $4.8 million gain for them at closing. $4.8 million more that they had to work with after the closing of their business. By the way, in this case, they were actually going on and starting another business. So this made a huge difference in what they had to work with in their next financial endeavor. They were switching gears entirely. This was a huge difference for them. So, by the way, they did have to take a good chunk of that 4.8. They took I think about $1.2 million and invested it to make sure that they covered themselves down the road for the taxes on this sale 30 years down the road. Here's a little smaller one. This was a couple of guys, 42-year-old gentlemen. Both of them were 42, same age, not related, but same age, who started a business when they were young guys, built it through blood, sweat, and tears into a very successful restaurant. And a bigger company came along and wanted to buy them out. They wanted the concept of their business more than anything. They really liked it. They're probably going to end up seeing it franchised. But they decided to take the payout today. And they were getting $2.5 million. Now, here's a couple of 42-year-old guys who started out literally working in the kitchen of a restaurant and now are selling the business for $2.5 million. They were pretty excited until they found out that after everything was said and done, what they were going to split was $1.5 million, actually just under $1.6 million. So they're going to walk away with $800,000. Well, guess what? At 42 years old, $800,000 a piece wasn't enough to retire on, that's for sure. And $800,000 a piece was not really quite enough to start another restaurant. So they were about to back out of the transaction and go, well, I guess we better keep our successful restaurant and just keep working rather than take this and try and do something else. Again, their CPA got us involved. The difference, once we ran all the numbers, was they walked away instead with $2,225,000 and split that two ways. Now they've got over $1 million each at 42. They can pretty much decide what they want to do going forward. Now that was just $315,000, $316,000 difference each for them, an extra $316,000 each. They ended up, we looked at what they were going to have to do to how much of that they were going to have to take to protect themselves when they got to 72 and the taxes got due. And initially they were going to have to take, I think it was about $60,000 each and invest it to protect themselves for the taxes 30 years down the road when they're 72. When they saw the power of the time value of money, these guys were really smart. They actually took the entire amount and invested it, and they have a guaranteed cash value waiting for them when they turn 72, far greater than the $2.5 million they made from selling the restaurant. So they can work and live wisely off the $800,000 that they would have had anyways over here. They're gonna move. Decided to move forward with that and continue to work and earn a living, knowing full well that at 72 they've got at least this much again coming to them just by reinvesting what they would have paid in taxes today, thanks to the time value of money. This is exciting stuff. If you're thinking about selling, this transaction really gives you more money for you to work with, more money for you to work with in your retirement, more money for you to work with in your next venture, more money for whatever it is the next in your life, that next period in your life. Now, I had a #1 best-selling book that I wrote, came out earlier this year in 2017, early 2017. This came out. It's available on Amazon, both in Kindle or paperback. It's called Half, the Updated Ultimate Guide to Cutting Your Taxes Guaranteed. I not put this up here because I want you to go buy my book. I really want you to see the subtitle, which is that little tiny print underneath the main title that says, "Why Paying Hundreds of Thousands of Dollars Less in Taxes Isn't Too Good to Be True." That subtitle is the result of having talked to literally thousands and thousands of people about these types of transactions over the years, and having way too many of them see the possibility, see all the supporting documentation for this, and then say, yeah, but I've never heard of this. My CPA has never heard of this. It just sounds too good to be true, so it probably is. And they end up making the decision to not move forward. Ladies and gentlemen, just because a financial transaction isn't something you or your CPA have heard of before doesn't mean it's too good to be true. There are a lot of people and a lot of major corporations who have done very well with this very same transaction. So don't be limited by that kind of thinking. Now, I want you to take your phone out and text the phone number 323-870-1040. Put that number into your phone, 323-870-1040, and text John's last name, Duncan, to that number. Text Duncan to that number, and we'll start a little text conversation with you. Get your first and last name, your email address, and then once we have that, we're going to send you out an email so you know how to connect with us. You know how to schedule a consultation with John to talk about, and myself, if need be, to talk about what's coming up for you transaction-wise and how can this benefit you, and then what can you do with the benefit that you received from this transaction. I hope you found this helpful. I hope you found it interesting, and I hope most of all that you'll have a prosperity mindset that allows you to consider doing something like this when you're selling real estate or business and looking to keep as much of what you've made as possible. John, thanks for having me on today. Always fun doing this and talking with your clients.
Hey, Wes, I really appreciate it. I love the ideas you shared today, and powerful stuff. So thanks a lot. Thank you for taking some time out today.
You bet.